Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. It's been interesting as usual. Very interesting. Watching what's going on, listening to what people are saying. I'm detecting a small, tiny tone of confidence. And that's a good thing. You got to look for it. You actually got to look pretty hard. But it's out there. And it's growing, so that's awesome. You know, I think one of the things that people ask, well, how long do you think it'll recover? Well, you don't really know, but the fact that it will recover, I'm pretty confident of. Why am I confident? Well, because you got 330 million people in this country, and all of them are in the habit of eating. That's a really hard habit to break, by the way. And they're all in the habit of living in some place, so they need shelter, and they're going to need clothing, and probably some dishwashing detergent. So, in other words, they're going to live life, and you got to have products around to do that. And if products can't be produced at a profit, they won't be there. So, anyway, the demand was curtailed by the government's shutdown, not by the public not wanting to buy anything. So I got to believe, is it going to be straight back up? Probably not. In fits and starts. A lot of small businesses have actually been shuttered. Incidentally, small businesses get shuttered every day, every week, every month, every year normally. This just sped that process up quite a bit. So it may take a little longer than it would normally take to recover from that when you've got a slightly larger numbers that are declining or going out of business. That's really tough. But I got to tell you, there are a whole bunch of college and high school graduates, as you're all aware of if you've been watching television, watching them do their commencement exercises through an online service. Those people are coming into the workplace. They're going to want to buy stuff. That's basically how this whole thing works. And anyway. So I've got I almost forgot. This is kind of big, actually. So there's a program that's out there, and there's actually an alliance of insurance companies that have gotten together and are basically bringing what used to be mainly in the realm of large corporations. They're bringing a product. They're bringing pension products to the general public. And the really cool thing about this is you do not have to belong to a union. You don't have to have a job that has the pension. You can do this yourself. You can actually sign up for what amounts to a personal pension program. And it's really good. It's extremely competitive. Extremely competitive. And I'm just really excited about it because I know most people crave certainty. They want to know. I can't tell you how many people. I've been doing seminars now for 30 years. I've been doing the radio program since 1996. And anytime I say the phrase I'm about to say, people will stop and listen. And the phrase is, when it's actually in response to a question, well, what do you think the market is going to do in the next 6 months? Well, I know exactly what it's going to do in the next 6 months. And this is where everybody gets quiet. I know exactly what it's going to do in the next 6 months. And you can hear a pin drop in the seminar, on the phone, in person, anytime I say that. And then they get the answer. The stock market's going to go up, and the stock market's going to go down. That is exactly what it's going to. And you know what? I have never been wrong. It's gone up and it's gone down. And then the look of disappointment comes over. And you know, I'm amazed that after all these years, the people still ask that question. The stock market will go up and the stock market will go down. Now, what's tough is, and I know what they want to hear, and then it's some certainty. And that's why there's these new product developments that are coming out across the entire industry. It's not just one company. I have one that I like the most, and I will tell you, it's Nationwide. Right now, I like Nationwide. But I'm also going to tell you that these companies, it's not going to take long for other companies to figure out what they're doing and duplicate it. Despite the fact that they have several patents on this process, they will still figure out a way to duplicate it. It's kind of like software. Can you imagine trying to write software for a living with all the programs that are out there, people, and all the apps that are out there? I think there are over billions of apps now. But anyway, so you need something that's unique, and this is going to put into people's lives something that they really crave. They crave certainty. They crave a promise. That's what they crave. That's why the bond market, despite the fact that it's paying next to nothing right now, the bond market is more than 4 times larger than the stock market is. Why? There used to be an old saying, gentlemen prefer bonds. Well, if gentlemen prefer bonds, it's because they don't know what they're missing. Okay? And they haven't known. And yes, they have preferred bonds because bonds give you an interest rate that's stated. The company or government entity says this is how much we're willing to pay each and every 6 months or every year. Some of them are actually monthly, but it's a stated fact. That's why they call it fixed income. They're going to pay that to the best of their ability. And then one day they're going to give you your money back. That's what a fixed income investment does. That's why they call it fixed. The income is fixed. The maturity date is fixed. The date that they're going, the amount that they're going to pay back is fixed. Okay. Hence the term fixed income. And you've got lots of different kinds out there, lots of different types of bonds. And then you have annuities that are fixed. You have index fixed annuities now. The annuities, by the way, there are thousands. Literally. There are more different types of annuities than there are stocks. Did you know that? There are more different types of annuities than there are stocks. So when somebody says the word annuity, you have to ask them, what kind? Which one is it? You know, it's like the same way, you should buy a stock and you'll get rich. Really? Which one? It's the same thing, except for in annuities. Now you've got multiples more choices than you do in the stock market. There are at least 10 times the number of types of annuities out there than there are stocks. That's mind-boggling. So, in a lot of them, if you can't understand what they're saying, don't invest in that one. Just don't invest in things that you don't understand. That's a big deal. And that really, I'm sure a lot of people think that they don't understand anything they're investing in. And that's true for the most part. A lot of people, I can tell you, it's not their job. It's not what they do. So in that case, better try to get with somebody you think you can trust. Yeah, who's looking out after your best interests. And that's kind of a big deal. But anyway, it's getting easier. That part, it's getting easier. I'm looking at one of the products right now, and when you're buying these annuities, you're buying basically a pension plan. They tell you they have a website, and if you wanted to email me or call me, go to my website, bullingtoncapital.com. I will gladly forward you the email address. Not email address. I'll gladly forward you the URL. That's basically the website, a link to the website where you can go in and you can see based on what your age is and how much money you're putting away. They'll give you an estimate. It's free. You put in this much. This is how much you can expect to receive at this age. And I think it's a really good deal. I mean, I think it's a wonderful deal. When you look at, over the last 5 years, the standard blended fund This is a all stock fund, no bonds. By the way, over the last 5 years, bonds have not done, they actually have done the same as stocks. So I guess you could take this across the board. The returns over the last 5 years are a little over 3% a year. That's it. Last 5 years, the stock market, because it's been so volatile, is just a little over 3% a year. And if that sounds really good to you and that's exciting, great. Call me up. You are easy to please. But these guaranteed products, by the way, are guaranteeing more than that. Okay. I got to find out on Monday through their compliance departments what I'm actually allowed to say. I really don't know. I just got approved. I just got the notification, so I'm just been approved to add this to my mix, and I think it's really good. It puts some certainty, or at least gives you some stronger guarantees to guarantee income, and that's what we're really talking about here. It's not the investment returns. And the investment returns of the stock market in general over long time periods are incredibly difficult to beat. Here's the difference. You're looking at over 20-year rolling time periods. That means 20 years. If you don't have a 20-year life expectancy, you got to look at what you have. And over a 10-year period, let's say 10 years, the stock market's had negative rolling 10-year time. What is a rolling 10-year time period? Well, let's say you went back to 1970 or 67, where the Dow crossed a certain number, and then 1967 to 1977, it was actually below where it was in 1967. 10 years later, and it's below. Okay? So that would be called a rolling time period, 10-year rolling. 68 through 78, guess what? Another 10-year period where it's below. So that's the next 10-year period. That can happen to you with your stock funds. You can have a 10-year period where your returns are actually negative. Why is that a problem? And then people go, yeah, but in the long run. And I'm looking at somebody who says that in their 60s thinking, you have no clue. You are clueless. You're in your 60s. Or actually, I still get it. People in their 70s. There was a gentleman used to call in here all the time. We'd have this conversation. There's a thing. It's called serial events. Basically, what order do these events come in? That long-term average might be 10% a year. Yeah, but what order did it come in? Those 10-year averages, when you're down significantly, and it takes more than 10 years or longer to come back. If you happen to be in retirement and are taking money out of that portfolio, you are in big trouble. You can't afford to do that. And a lot of people get that. They know that. Okay? A lot of people aren't. And I know, by the way, I'm thinking of 4 people right now who think I'm talking about them. You know why I'm thinking about 4 people that think I'm talking about them? Because I'm old and I've forgotten about the dozens of other people that had the same conversation. That's not unique. Don't feel bad. I'm not picking on anybody. That's that's a fairly common assumption. I want the highest returns. No, you don't. The highest returns fluctuate the most. That may be fine if you're below the age of 50. If you're 50 or younger, yeah, go for it. If you're really, 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 really rich and are not going to need your money in the next 15 years, go for it. If you're not really, 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 really rich and you're past the age of 50, you better give that a second thought. And the second thought is let's try to figure out, maybe there's a way that we can kind of guarantee a portion of our portfolios to the best of our ability, and then a small portion of it or a large portion of it, depending on your risk tolerance, your time horizon, all that other stuff. Do you have a pension? That all that stuff makes a difference. But how aggressive can we be with the stock side? Because on the stock side, I think you're going to do very well over the next 10 years. Why? Well, I look at valuations. They're extremely reasonable, especially when you get outside of large cap U.S. stocks. If you get out of the big boys in the United States, most of the other categories are extremely reasonable. We'll talk about that in a future show and hopefully a future seminar one of these days. When the facility, as soon as the facility's open, we'll schedule a seminar to talk about this, because this is pretty exciting stuff. You can these developments are relatively new. These options did not exist a couple of years ago, and that's pretty good. They've improved lately. They've improved, and I think that's a wonderful thing, especially since the population in the United States is getting older. As a country, we're getting older. As a country, more people are entering the 60-plus category than in the history of the country. I mean, you've probably heard this statistic somewhere before, but about 10,000 people a day, 10,000 people a day are turning 60. And I believe 10,000 people a day are actually qualifying for Medicare. What does that tell you? The older you get, by the way, the more more you have a tendency to spend money on health care. Larger percentage of your income goes towards health care costs because your body starts to wear out. Anybody that's over the age of 65 knows exactly what I'm talking about. Anybody that's my age and played college football knows exactly what I'm talking about. And that's a kind of a big deal. So that, and this is another thing that we've talked about a few times on the show, but I've just recently gotten together a model. It's an aggressive model for those people that want to be aggressive with some portion of their money. And we'll talk about that a little bit more when we come back from these commercial breaks, from this commercial break. You're listening to Bill Bullington right here on 1420. Stay tuned, because I'll be right back. And we're back. Now, I do this every time. We go to a commercial break. I start reading and looking around, and next thing you know, we're coming back from the commercial break, and I forgot what I was talking about before the commercial break started. Don't get old. I'm just kidding. But anyway, we were talking about there's some new benefits that have come out. I've just become aware of, just got licensed to be able to represent those products because I think they're a very good idea. I think it's something that almost everybody should consider today, especially if you're within 10 years of retirement and you'd like to calm down the fluctuation a little bit of your investment portfolio, but you don't want to give up a lot of return. Give me a call. I will send you the links. You can actually look at all this stuff online. And then if you want to talk more about it, then give me a call. So at Bullington Capital, we are not low pressure. We are no pressure. There's no pressure to do anything. Okay? And if you decide that, if you're looking for an advisor, feel free to set up it can be a phone meeting or in person. Actually, I've been doing almost all my meetings over the phone over the past few months. I think you all know why, but that's okay. Don't mind meeting. If you want to come into the office, that's great. See kind of where we hang out during the day. Me, Melissa, Gary, Brad, by the way, works out of his house. So there's 4 of us there. There's about, I don't know how many thousands of people that work at E-Trade and Fidelity, but those are the 2 custodians that we work with. We have teams of people there that are designated just to work with us. So you get the best of both worlds, actually. You get the high touch, high service level of a small firm, and you've got all the benefits of all the features that the big firms have. And they don't tell us what to do. So we work for you. That's kind of how it works. And man, there's so much going on. And not the negative, bad news. I mean, of course, there's always a lot of that stuff going on. But there's a lot of really good positive developments that are coming out of a lot of this stuff. It's setting the entire world up for the next surge in productivity. That's kind of what happens sometimes when you're hit with a pandemic or other unfortunate circumstances. That actually oftentimes leads to growth. How many times have you heard about that even personally? You go through something that's really hard and you come out stronger. And I think that's kind of where we're at now. And I have no doubt in my mind when this is over, things are going to rebound. And I think they're going to rebound quicker than people probably realize that they're going to rebound. And I'm going to run for president in 2020. Just thought I'd throw that in there to see if you were listening. I am going to run for president, though. I'll get one vote at least. I'll get my own vote. And my whole platform is simplify the tax code. That's my platform. That's all I want to get accomplished. Just simplify it. Do you know that Russia, as backwards as that country is, the only thing they actually lead the world in production is vodka. I'm actually kidding. They probably eat in some other things. And there are competitors in certain areas, but all other things being equal, there's not much competition in a whole lot of areas. As backwards as they are economically, they have a flat tax. Are you kidding me? Do you know why? It's because their leader, who's also probably the richest guy in the world, nobody knows his net worth because he won't publish it. And you'd probably get shot if you did know and started telling people. But he is also very astute financially and realized the fallacy or the, can't think of the word now, how much wasted effort it is to have a tax code that's got thousands and thousands of pages in it. That's idiotic. And I kept thinking, way back over 30 years ago, surely somebody is going to see how much of a waste of time, effort, and energy this is. And unless you went to law school and then got your master's in taxation, to be able to try to weave those networks and continuously have to go to school because they continuously change that stuff. Yeah, you guys probably hate guys like me. So if I do get elected president on that platform, I'll probably get assassinated by a CPA. Actually, not a CPA, because a tax preparer, because CPAs do different stuff. By the way, you still need CPAs, and you still need lawyers. There's still business agreements, there's still patents. There's all kinds of stuff that they can still do. I just don't think we should be spending that much time, effort, and energy on taxes. That's nuts. Absolutely crazy. You go to a flat tax and a national sales tax. We got to pay the bills. But you don't have to punish people who are in median and slightly upper level incomes and then give the billionaires a break. Billionaires don't need a break. They can afford it. And, a lot of, by the way, a lot of billionaires, don't care. But a flat tax, I'm saying a flat tax, 20%, and you adjust the, personal exemptions based on the cost of living in the area you live in, because it costs a whole lot more money to live in New York City than it does in Copley, Ohio. Like a whole lot more. So, and that would, everybody's going to argue over that. So what? It's not as much to argue about. That's only one argument. And you get rid of thousands of other arguments by saying flat tax. And think about that. And you know where I first got this idea? I was working with my father, and we were remodeling a house, old house. I love old homes, by the way, but because we fixed up a bunch of them, and it was amazing. This is way before HDTV. It was amazing what you could do. Make that old house look brand new. And the bones on a house, they used to actually, the 2x4 was actually 2 inches by 4 inches. That's why they called it a 2x4. It's not 2 inches by 4 inches anymore. It hasn't been for decades. But anyway, they were a lot of the old houses were built very sturdy, had good bones. So we're taking apart some of that stuff, building second floors on, putting dormers in attics, all kinds of stuff. And I reached down into one of the eaves. Back then, in those days, they didn't have insulation when these houses were built, mostly around the early 1900s. And I reach and I pull out a paper, and it's actually the Cleveland Press from the early 1900s. And I'm looking at it and going, wow, look at that. I was looking at the cost of clothing and all these coupons they had in there, and I'm, whoa, that was really cheap. And then I see this something that looks like a coupon. I start reading it, and this is actually a tax return. It was a tax return. They put it on a coupon size article and said, fill this out and send it into the IRS, and you're good. That was it. That was the tax code. How much did you make? Okay, this is how much you owe. And literally, the tax return was a coupon in the newspaper. Now, why can't we get back to those days? I'll tell you why. A lot of lobbyists, I'd probably get shot outside the radio station today from the people that derive their living by figuring out, loopholes in the tax code. What a waste of energy. What a waste of money. And you can make it fair. And why should somebody who makes under $100,000 pay a percentage of their income that somebody who makes over $1 billion doesn't have to pay? That's not right. That's not fair. So anyway, that's my whole platform. Flat tax. Well, do your tax return in about 10 minutes. Yeah, I know it's probably not going to be. By the way, you still need accountants, because you still have to buy stuff, you inventory. You got to figure out what your profits are. But the way that you figure out profits is you take all your expenses from all the income. Voila. That's simple. I saw Bill Gates making fun of that one day. Yeah, it's because he hires these super high-priced $1,000 an hour tax attorneys to try to figure out some loopholes. And doesn't realize, simpler is better. In many, many, many cases, simpler would be better. And actually more fair. So I'm going to develop that. I just started thinking about this last night, by the way, so that's it's not fully complete yet. Next week, I'll give a little bit more information on it, but that's my platform for the 2020 election. I realize I'm a little late. I have no hopes of getting more than one vote. But that would be my platform, just to get that changed. It's madness that we have to worry about doing tax returns. That is madness. It's idiotic. It's a huge waste of money, resources. And I know an awful lot of people that work for H&R Block are going, somebody shoot that guy. Somebody shut him up. Yeah. Now, if you're an accountant, there's a lot of other accounting work. You have to figure out what those profits are. And by the way, to supplement that, I would actually go for a national sales tax too. Wouldn't be a lot, but between those two, I think it would simplify the tax system, something that gives people, gives them so much stress every year. It would be so much easier. How much did you make? Okay, send this in. How much did you sell? Okay, there's a tax in there. You add the tax to the sales price, and the customer pays for that. That makes, by the way, I hear people, wealthy people, oftentimes complaining that people that are on welfare don't pay any taxes, and they complain openly to me. So my solution: give a national sales tax. That way, they're paying some taxes. Now, be quiet. Go back to what you're doing. I'm just kidding. But yeah, national sales tax, 5, 6, 7%, something like that. That's huge. You know how many products and goods are sold in the United States every year? It's about 22, 23 trillion, somewhere around that. Maybe 24 trillion. 5% of that, you're talking about over $1 trillion. That's more than a third that's more than a third than they collected all of last year. Voila. We're rolling in the dough. Flat tax, small national sales tax, we're good. And we can concentrate on things like educating our kids. That's a big deal. We need a bunch of kids going to school, learning how to weld, be plumbers and electricians and carpenters. You ever looked into that lately? Looked at the news? There's a massive shortage of skilled workers. Massive shortage. We need to be making it a little easier for them to go to school, get that education. And, anyway, sounds like I'm a tax and spend, but I'm not, because that's actually what we're doing now. And I'm not again. I don't like the way that's being. Actually, this is not a political show, but economics and the United States is the only country that teaches economics as a standalone science. Every other country teaches it as political economics, because that's actually what it is. You know, I don't think anybody should be able to avoid taxes that should be paying them. I don't think anybody should. That includes everybody. I mean, down to people that, we all have to pay something. But anyway, that's not going to help. And the economy is going to recover. It's recovering as we speak. You just can't really see it yet, except for any place other than the stock market. Which is incidentally what happens. The stocks generally run out ahead of the economy. So, and everybody, this is one of the reasons that this is so hard for so many people that are investors for so long. When you wait to see the economic numbers, the statistics that actually get recorded and then reported, it's too late. 9 out of 10 times, it's going to be too late. The market will already have recovered. In fact, the market may go down on that news temporarily because most of it was already factored in. And so the average investor makes that same mistake almost each and every time. And they think that, they wait for the news to be good. That's not a good thing. If the news is already good, it's probably already priced in, and more than likely the market the super smart investors start to take profits. So that's where we are now. If you haven't rebalanced your portfolio in a while, you might want to. Might be a good time. In fact, the rebalancing thing is the most beneficial thing that you can possibly do. It's the most beneficial. Let's say you start off, you're a 60-40, or which is the most common, by the way. 60% of your money is in stocks, 40% of your money is in bonds. You are dying right now if you're looking at your returns over the last 4 or 5 years, because they stink. They all stink. It's been rough. It's been a rough 4 or 5 years. That won't stay that way forever. And eventually, should go substantially higher than that. But last 4 or 5 years, you look at a chart of the stock market, take the Russell 3000, 1000, the S&P 500, look at them all. They're barely up at all. Yeah, it was up a lot from the bottom of the market this year, but it's still not back to where it started out at. Okay. And that story, I've seen this before. So in the long run, is it probably one of the better places to be? Yep, especially with interest rates as low as they are. You can't rely on CDs. You can't rely on government bonds. You can't rely on savings accounts or money market accounts because they're not generating enough cash. So stocks are doing well relative to that. Anyway, I hear the music. I got to take a real quick commercial break. You're listening to Bill Bullington right here on 1420. Stay tuned because I'll be right back. If I made anybody mad, I apologize. I'll talk to you soon.
Where this is going and where you're leading me, I wish I knew how. Been down a broken road now, I've been through that fire. There's angels holding on to both sides of the wire.
And we're back. If you have a phone call or question, 216-901-0945, 216-901-0945. And just to be clear, I don't want to really offend anybody. I know you can get in big trouble talking about politics and religion. And I would add money to that list, or any closely held belief system that you have. that somebody challenges at some point in time. I really don't mean anything by it. I just really wish that the tax code were simpler. That's all I'm saying. I just really wish they would spend some time on that and make it easier. There's no need for that. So anyway, I'll let that go completely and talk about the desire to generate income in retirement. That's kind of a big deal. It's a really big deal. It's kind of, isn't that what we're all really working for? You know, I was thinking the other day, back when I first started in this industry a long time ago, I was thinking about, retirement. I was fairly young to start thinking about that at that time. I didn't get into this industry till I think I was about 26 or so. But anyway, in the first 3 or 4 years, you're just swimming in information, and it takes a while to get your arms around the whole thing. And so by the time I really realized, how much money it took to be able to retire, I was like, whoa, wow, you are never too young to start thinking about retirement. Now, it doesn't have to be complicated. And this is where I'm going to part ways with the financial planning institutions out there. They make everything so hard, just like the tax code. It's so hard that people give up. They're discouraging people from doing the right things because they're making it so hard. Oh, you got to do this, this is a must do. No. Bottom line is you need to put a small percentage of your income away. You got that? That's it. That's all you have to say about that. And, well, actually, about that particular point. Great. If you want to do a budget. Absolutely. Start the top of the list on the budget is what you're going to put aside. Pay yourself first. You should come first. That's one of the things that they said in this industry that they got completely right. And so pay yourself first. Figure out when you're really young. Now, I'm talking about this because I have a couple of interns now who are basically trying to, sorry about that. I have a couple of interns that are trying to figure out their way around the business, and they're going to graduate next year with finance degrees. And they don't talk about personal finance. They don't talk about this stuff. I didn't see this stuff until I was out of school for a long time. And it needs to be talked about. Actually, they should start teaching this around middle school, because by the time you're in middle school, you've already learned percentages. And that's what you really need to be good at. What's 5% of $1 million? It's 50,000. Okay. What did I just say there? In order to spend $50,000, if you're going to spend 5%, you need $1 million. Got that? It's pretty easy. Now, you may not need $1 million with some of the most recent developments. It'll be a little bit less than $1 million. Okay, not a whole lot less. So you got to get to that $1 million. Why am I emphasizing this? Because, it's relatively simple. For every $50,000 you want to have, you should probably have close to $1 million. Yeah. And you need to tell kids when they're right around 12. And because then they're not as intimidated by that number. You tell a kid who's in their 20s, they're thinking to themselves, holy cow, if I have to save up $1 million, by the way, that's the good news. The bad news is by the time you're, 60, it's going to be twice that amount. So you're actually going to have to save $2 million. Now you've lost them. You've lost them unless they're super serious about it. So you got to kind of ease into that. And you got to show them, here's the average annual income. Here's how much you have to put away to reach those numbers. Here's the rate of return that you need. You need to assume something that's relatively reasonable, not that you're going to average, 12% a year with no risk. That's not going to happen. You're not going to probably not going to average 10% a year. We don't know exactly what you're going to average, but we do know which asset classes tend to perform the best, no matter what happens. So that's and by the way, you have to remember there too, there's no guarantee. If you want complete guarantees, you're going to have to put away a lot more money. Okay, so So we'll be talking about that in the future. I do have to take a phone call real quick. And is this Jerry, the options trader?
This is me, William. I do have a question. It actually runs along what you're talking about this morning. What happened in my portfolio this spring? I did not estimate, or I had no solid feeling that the coronavirus was going to be anywhere nearly as decimating as it was.
You didn't?
To probably everyone else.
You didn't know that? I'm just kidding.
No, but no, my wife is a medical professional, but I don't think a soul knew it was going to be as ugly as it became. Or they'd be a liar or a fool if they did.
Yep.
But anyhow, I didn't sell. I was foolish enough not to have a floor. I went down with the market. I was down maybe 25%. Mm-hmm. Fortunately, I put money at the low point back in, and I'm well past where I was come February of 2020. Was the only thing I could have done differently is if I had put a floor in on the portfolio, say 10%, that would have got me out.
Well, basically what you're asking for is you're asking for a magic formula.
Well, no, not really.
No, yes, you are. You just don't realize it because you want to hear the answer so badly that you're willing to be blindsided by your desire. You can't know that.
What I was going to say, Bill, if you put a 10% floor under your holdings and things, I thought that was one of your.
Nope. You got to go back and read the website. You did not read it. It's at lookoutforthebull.com.
My mistake. Then I thought that was it. Obviously, I got the low side, but the high side was a total fool.
That's what you get for thinking.
There's no way you could have guessed it. There's absolutely no way one could have begun to imagine it was going to be as ugly as it turned out to be.
So here's the thing that I kind of live by. Is stay in the moment. Don't try to forecast. Try to observe what's happening right now. And for the vast majority of people, that means they're going to have a breakdown of stock funds and short-term bonds and some cash in their accounts, and they should have an allocation in mind that they're going to go back to. So when the market's down, when the S&P's gone from 3,400 to 2,200, okay, if they're rebalancing, the stock portion's not going to be 60% of their portfolio anymore. It's going to be less than that. They're actually going to take a small percentage of the bonds and add to the stocks. By the way, they won't hit the bottom like that. There are two types of people that buy at bottoms and sell at tops. They're the lucky, and then there are the liars.
Yeah, right.
Yeah.
Of course.
And by the way, the lucky never sell at the top and buy at the bottom. They don't get lucky twice in a row like that.
No, I agree with you entirely. I just thought by putting a floor underneath it.
No, that's wishful thinking, and I've already tested that a gazillion times, and so have a lot of other people. If you Google that, then you're going to get, well, first of all, you're actually going to get a lot of con artists that say that this number works, and then they'll show you carefully selected scenarios where it does work, but when you subject it to rigorous back testing, it doesn't work. There are no magic formulas. In fact, that was written about in a book called Technical Analysis of our Technical Market Indicators. And you can see it there. There are a lot of things that could have added value. You and me don't have the kind of time it would take to run the portfolios the way that the ones that have been the most successful, and you have to be willing to lose money on more transactions than you make money on. And everybody that
I make it on big on the
that's what happens. You're going to take a lot of small losses, and occasionally you're going to get a big winner. In fact, there's a fund, one of the top performing funds in the world over the last 5 years. It's up 269% over the last 5 years.
Jeez.
The last 12 months, it was up 40,000%. I'm sorry, I'm sorry, 4,000%. So if you're up 40 times, how much were you down by if you're only up 269 now?
Yeah.
You're down over 90%.
Jeez. Jeez.
So if you want to be the guy that says, yeah, I made the 269%, well, guess what? You're
going to take the lumps with it.
Yes, you got to be willing to do that. And there was this guy, I always laugh about this. This guy's, his name was Victor Niederhofer. The guy was a mathematician.
Yeah, we talked about him, I'm sure. Yeah.
Because mathematically, this dude was a genius. I mean, he was literally a genius. But he let his psychological bias override his mathematical ability. He knew what he wanted, and he felt like somehow magically he would just be able to avoid that one small percentage of a chance that things go wrong.
Yeah.
And he did it for an incredibly long time period. And he was rich by anybody's standards. And he blew up that entire fund in one day. And he blew up he lost all of his own personal money. This guy's a PhD mathematician from University of Chicago, who basically invented securities analysis or the study of it. And anyway, Jerry, can't believe it.
Is that technical analysis? Is what you're saying?
Yeah, part of it was, but I'm going to have to finish this next week because I ran out of time. Hey, thanks for calling, though. And for the rest of you, if you'd like to get a hold of me, go to my website, bullingtoncapital.com. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.